Hello. Good morning, everybody, and welcome to today's session, today's live session on financial modeling and valuations. I hope you've enjoyed the music. The music was by DJ Google. Maybe at some point I should think about changing my career, but I'll wait for messages from you to encourage me forward. Anyway, so we're going to get started with our session today. I think we seem to have quorum. So we're very fortunate today to be joined by Tony Wainaina, we're going to be having a chat with him around financial modeling and valuations from a practical perspective. Of course, this is to augment everything we're learning in our financial modeling course as it moves on. Just to lay the groundwork, this is what we've covered so far. We've gone through these topics here. We had the session last week on sensitivity and scenario analysis, and this week we're having one on valuation. Next week we're supposed to have another one on dashboards, and then there's another one coming up on updating financial model with actuals. So I hope you're keeping up. I know the content has been coming quite fast at you, but that is what happens at times with the financial modeling. You have to sort of like get everything on board to get things moving. So in terms of today's session and how we plan the session, we are currently doing the introduction to the session. Then after that, we'll start. I'll ask Tony at some point to put on his video. Then we can start the chat with him, and then we'll open it up to Q&A for the last 15 minutes from 11:40. So if you have any questions, feel free to start typing them in. If you have any expectations around, valuation and so forth, type them in. Tony is one of the most experienced private equity practitioners I know, and we're very fortunate to have him on board for this conversation. So then we'll close at 12 o'clock promptly. Just moving on, a quick introduction about Tony. So he's a director at Origins Investment Group Advisors. So it's a company that does advisory work for chamas, especially chamas that want to scale the heights. So some of the work he's done previously is work with Transcentury, with Centum, and so at least as far as I understand, it's then taking chamas that are really looking to grow to the next level and get them to that point. But his prior experience in the finance space is unrivaled. In private equity, he was the CEO at Centum for a number of years. He was the CEO at Transcentury for a number of years. He was a managing partner at Fanisi for more than 7 years, I believe. And Fanisi is a venture capital firm that has made a number of key investments in our ecosystem. So I'm really excited to be having this conversation with him. And we'll just get started. Tony, I'll stop sharing my screen at this point. I'll request you to put on your video and to put on your microphone. And then I'll just try and spotlight. Spotlight. Okay, brilliant. So as I mentioned, if you have any questions, feel free to ask them. We'll be dealing with each of the questions towards the end. So Tony, karibu and welcome to this session. We are very excited to have you on board. I'll start by just telling you, I've tried to do a bit of justice introducing yourself, but I'm sure you can add a bit more. So I'll just try and start by saying welcome and please introduce yourself.
Okay, thank you, Stephen, for that very generous introduction. I really don't have much more to say, other than probably since I stepped back from active involvement in private equity with Fanisi. It's been just over a year now. I've been taking time to get involved in other passions of mine, I guess. As you mentioned, I've been doing quite a bit of work in the investment group Chama space. Last year, I also, you were involved, Stephen, launched a second edition of a book that I had written and published called the Investment Group Handbook that dealt with some of these issues we'll be discussing today, particularly around valuation and investing in private equity. So I'm involved in, I guess, sitting on a number of boards, helping them with everything from capital structuring to capital raising, enterprise risk management. Again, these are factors that are important when modeling or looking at valuations, and also advising some of the, some interesting ventures around the SPAC space. I'm sure you're aware of what SPACs are, these special purpose acquisition vehicles, working with a few people to see whether we can set something up in for East Africa pretty soon. So happy to be here. Thank you, Stephen.
Oh, thanks. I feel like maybe digging a bit into the Sparks point that you've just mentioned, since this is a conversation anyway, even as we get to the content.
Yes.
So how do Sparks work? Just for someone who's hearing this term for the first time.
At a very basic level, these are essentially, I'll give an analogy. It's like setting up a listed private equity fund. So there are no investments, there are no assets that exist in this vehicle. It's a shell that raises capital. It is public company, with the promise to its investors to deploy this capital in specific sectors. Some of them are agnostic, they're investing across the board. So very simply put, I mean, these are, call them public equity funds, but they're regulated in the US and I'm sure a number of the European markets. It's not happened in this part of the world yet, but I can see it happening. But the beauty about them is that it does provide a lot of flexibility, and it's all alignment between the sponsors and the investors as well in terms of incentivization and profit sharing. But it also opens up this market to especially investing in the tech space. So that's what they are.
For anyone who's interested, you can double click on that topic, Google it. I'm sure you'll get a bit more around that. So let's focus on the topic of the day, financial modeling and valuation. I'm sure you've worked with models. I mean, in your experience in the financial services space, you've worked with financial models separately. What are some key reasons why you had to interact with financial models? Why did you sort of like dig deeper into them?
Very simply put, I mean, it's a crystal ball in a sense. It gives you an eye into the future. It allows you to predict the outcome or the most likely outcome of your investment using a number of assumptions. You can, ultimately get a feel for what kind of exit valuations you'll be looking for at the end of the investment holding period. So especially for limited life private equity funds, I mean, financial models are really the best tool that we have to help us incorporate all manner of assumptions, using hard numbers. We can take a view on what the future is going to look like. It's not an exact science. It never is. Okay. Mm-hmm. One of the discussions I guess we'll be having a bit later on is how the model never ends. You can never put a full stop to the model. It's dynamic. Mm-hmm. You have to keep adjusting it, as your investment journey continues. But essentially, that's what it is. It helps to scenario plan. And as you all know, you typically have, worst to best case scenario and everything in between. I remember in my earlier days, and this is typical of a lot of young analysts, they would be very defensive of the best case scenario that they will have come up with in their models. But I think with experience, I definitely take, if not the worst, it's the worst case scenario that the financial model produces, because there are so many unknowns out there. You can assume at the very beginning of your investment journey, make assumptions, but literally, whoever imagined COVID as a pandemic. Whoever modeled COVID in their financial model. And then, you are relying on historical and, call them base numbers, that your potential, again, talking from a PE perspective, that your investees have presented you with. These are what our audited numbers look like. Or this is what our management accounts look like. But from painful experience, I would never rely on the last set of audited accounts or management accounts to base my financial modeling on. They do have to be re-audited with auditors that we select, so we are comfortable with. But those are the reasons why I use them.
I find that interesting, and this opens so many avenues we could take this conversation. Though there's one avenue I want to take, but I like this idea that you mentioned that you found that you could not rely on the audited financial statements. You had to get them re-audited. Maybe just digging a bit on that. Did it, assuming it was a Big Four, would that give you more credibility and you'd say, that's PwC, so we're going to use those financials? Or was it just a principle that you just said, there's certain aspects that you feel auditors do not cover, and so if you get your own set of auditors, they would be able to, maybe dig a bit deeper into those specific issues before you employ those numbers?
It's a latter. It's a principle. It doesn't matter which Big Four firm has been the auditor of this particular company that we'd be looking at. But you have a relationship with, and it doesn't have to be one of the Big Four. It could be a sort of second-tier firm made up of ex-Big Four auditors. But they have a feel for what we would be looking for as private equity investors. Even with the Big Four, there are always discussions back and forth. Can we, adjust this, adjust that? These are certain items that we feel need to be expensed, and you put your case forward, and the auditor accepts. No firm obviously wants their accounts to be qualified. There have been some cases, even with the Big Four, where accounts that really should have been audited, qualified, or there should have been some emphasis of matter supported by very, strong reasons, that just doesn't happen. So it's a comfort level. You need to defend your numbers. Remember that. You always need to defend your numbers not only to your investment committee, but ultimately to your investors. So you can never say that we can't be blamed for this because we were relying on audited accounts that the investee gave us. So that's the reason why.
That's interesting because it raises many questions for analysts when, you're given a set of financial statements. That's what you're going to use for your forecast to be able to generate your valuation. But then there's a big question. It's almost like a black box then, what you're saying, that the numbers you get, you shouldn't trust them 100%. And you said the auditors you bring on board would know what you would be looking for.
Yes.
So for instance, what are some key things, 1, 2, 3 things that you'd say that, aside from the normal audit statements that you receive, these are critical things that we would be more interested in as a fund when you're looking to make an investment?
Yeah. The biggest one by far is cash flow. So the business claims, according to the audited financial statements, that this is the cash position at the end of the financial year. So one, we want to get as close as possible to audited numbers that will tell us the cash position closing month prior to, or the latest month. Let's say we're making this investment in April. So end of March, what do the numbers look like? What's the actual cash flow position? What's in the bank? What's in receivables? What is the quality of these receivables? How collectible are they? Because that is the single biggest risk that you're taking. Investing in a business where you've underestimated the working capital requirements, and based your investment, the money that you're requesting from your investors, on the cash flow position of the business at the time you're investing. Because the biggest nightmare is having to go back to your investment committee or investors saying that actually we underestimated the cash needs of the business, and can you please give us some more money, right? So that for me is the biggest one. But then I talked about quality. Okay, what sort of inventory quality are we talking about? How collectible? What sort of valuation are you placing on these assets? Everything from your land, equipment, liquid assets especially. Are there any contingent liabilities that are not clearly understood? Okay. What sort of lease agreements has the business entered into? Are there any skeletons in the closet? So we really need an auditor who is able to ask these tough questions, to dig deep, okay? Give us that level of comfort that we are dealing with a business where there is a reasonable level of certainty, as high as possible, on the position of cash flows, on the value of especially the more liquid assets in the business. Yeah, it's for those reasons primarily.
I like those. I mean, cash being the biggest risk, the issue of any liabilities that may be there, valuation of the different, assets that the company has. I think some really good points for someone to look at, even if you don't re-audit, but at least questioning those numbers as you're getting to start using them for your financial model at the end of the day, I think would add value.
If I could just add one more, I think another big one, where you would typically take warranties, and you obviously never want these warranties to crystallize, okay? But there's this sort of industry practice of just, you have tax liabilities. The taxman has assessed, and these are the outstanding liabilities. A number of these companies will tell you that we are in discussions with the taxman. The probability of these liabilities actually crystallizing is very minimal, so you take out warranties, okay? Now, what does that mean exactly? And again, you need a solid auditor or tax advisor. So as we're doing the audit, we're also bringing in a tax advisor that can give us a very clear view on the risk of these tax liabilities crystallizing. And as much as possible, I would tend to avoid companies that have sort of a history of a difficult history with a taxman, and they're constantly, being assessed, and they, sometimes miraculously it appears as if these liabilities over the years have disappeared. What has been their relationship with it? You know what I mean? Integrity issues in terms of relationships with a taxman could come back to bite them. So I just thought I'd add that one.
Okay, that's a good one also. Thank you for adding that. But I think the key point I'm picking from this is don't pick audited financial statements and just say, since they're audited, let's use them for a financial model. And when we ask, you say, they're audited financials, so what could we have done? Okay. So then just jumping in, I'm sure you've seen quite a number of models in your experience in the finance space. What would you say are some key attributes of good models? Because I'm sure you could tell now, this is a good model, this is a very bad model. What are the key practical aspects that you would say represented good financial models?
Okay, I'll answer that question from the perspective of a user, okay? Because I'm no financial modeling wizard. I have to confess that I've had other people model people smarter than me and more technically astute. But I think I've obviously had to rely on good quality models when making decisions around valuations, pricing, things like that. Okay, so there are probably 3 to 4. One is that the assumptions must be realistic, okay? You know, we are trying to acquire this asset as the investor at the fairest possible valuation. I avoid saying the lowest valuation, okay? But the fairest valuation. You never want to overpay for an asset. And that's why as I mentioned before, I would tend to assume the worst case scenario as my base case, okay? So really, the modeler must really understand the market and the dynamics they're dealing with. Don't take the word of the investee, okay? Of the company that you are evaluating, you're developing a model for. Do your own fact finding, do your own fact checking, do your own research, and own that financial model completely. But the assumptions must be realistic. Secondly, it's got to be easy. It's got to be user friendly, okay? So easy for the user to understand, okay? There's a tendency for modelers to get lost in their models. And nobody but the modeler can understand, especially when you want to be able to allow the user to make their own adjustments to the model and to understand, you know, every variable that needs to be switched or manipulated. It's got to be neat and tidy, okay? No sort of unknown numbers and figures or whatever, just sort of, you know, left in the worksheet or the model that have absolutely nothing to do with the model. So I think it's a discipline. As soon as, before you present this model to the users, the analyst must just clean it up, okay? And make sure that it's easy to read and to follow. So just always remember that the designer or the modeler is not doing it for themselves. They're doing it for, call it third-party use. And also assume that, you know, I always make the point of ensuring that the investee, the party we are acquiring the investment from, also is able to use the model and understand the model, because we always have a session where we are going through the model with the potential investees. So they are the providers of a lot of these assumptions, especially the operating assumptions. So they've got to understand how this model works as well. And it can be challenging when you're dealing with investees that do not have a finance or investment background. Thirdly, it's got to pass audit, okay? And I refer to internal and external audit, because one of the things we used to do was one analyst would model, and then it would be shared with the rest of the team, especially the other analysts and the senior analysts and investment officers. They need to actually critically and thoroughly go through the model and give their feedback. But, you know, through painful lessons, we learned the importance of getting an external party to audit the model as well. And that's simply because, you know, of the size and complexity of these models. Yeah, one small error can result in, you know, what I would refer to as a MAC. Okay, so this material adverse condition, which could have disastrous outcomes. Right.
Yeah.
And then, yeah, finally, it's related to the point I made about it being user friendly. It's got to be fully interactive. And you know, where you can adjust and manipulate any field. My biggest annoyance or frustration comes when I come across hard numbers, which should just not exist, where they should be, you know, formulas, or it should be linked to another part of the spreadsheet. So I think those are the most important attributes I would consider.
I like those points, and especially this point you brought around the audit. that both internal and external. There's a nice article, if you Google it, you can find it, how Excel ruined the world. And it's just about how modelers, you build very complex things and there's a formula that is off and nobody catches it, and then it caught much later, and it has disastrous impacts. Very, very good points there. Okay, so now, so there's a model itself, then there's a modeler, and I think you spoke about one of these aspects, that the modeler needs to be a bit realistic. They need to own the financial model. Are there any other aspects that, as a modeler, as an analyst, who's then charged with build a model to value this entity, etc., that someone should be having, or that you expect them to have?
Okay. I think the first one clearly is they need to be technically astute, okay? So they need to know what not only what they're working with in terms of the spreadsheet and the worksheets and how the whole thing comes together, but they need to understand what a balance sheet is, what a cash flow statement is, what a P&L statement is, what a capex schedule is. So all the components of that financial model need to be clearly understood, and you are not taking liberties with how the balance sheet that you're forecasting is balancing. You've got to be very honest. I think that's another attribute as you're putting this model together. So integrity is important. You've got to be patient, and a certain level of humility is also important. Let your model speak for itself, right? Don't speak up the model, saying how fantastic you think it is, how much time you've put into it. Let the model speak for itself, right?
Yeah.
And then be a good listener. Be open to constructive criticism. Some modelers are very possessive and take their models very personally, and they're very unwilling to admitting they don't know, especially. Right? And if you don't know, say you don't know. I talked about honesty. Don't assume that you are the beginning and the end, the alpha and omega of this model. And then never assume the model is complete. We are operating in a dynamic environment. The environment, the market the business is operating in is changing, and especially these days, literally sometimes from month to month. So don't assume that the model you developed on day one is going to be the same model that will apply 6 months down the road just before you make your investment. Okay, you've got to be open to what aspects of the environment am I dealing with needs to be considered to adjust some of the assumptions that are going into the model. So those are the other attributes I'd refer to.
I hope everybody's taking notes, because those are very good points. I hope I knew these attributes before I started modeling. I have this funny story where the first time I encountered the term EBITDA, I thought someone had misspelled EBIT and then added the DA. So I did my computation based on EBIT, because I was like, who gets this wrong? Only I didn't know what it was, and I didn't ask. I didn't have maybe the humility, so to say. Only to present finally, and then someone to say EBITDA, depreciation and amortization, and then for me to Google it and say, oh, okay, so actually it means something else in finance. So that's ability to ask questions, to say, I don't know, what does this mean exactly? Because there's also these expectations in finance that you need to know all the acronyms.
Exactly.
Sometimes people are talking really fast, it's a transaction that's moving, and as an analyst, you can get caught up in that whole process. So I like that aspect of honesty, integrity, and humility. Okay, so let's dig into valuations a bit. How important are models for valuation, right? And I ask this question, from this perspective, that at times, as a very experienced professional, when you see an asset, when you see something, you have a sense of what the valuation would be. But then you still need the financial model. So I'm always wondering, how important are they?
Okay. I think they're important. They're important, but they're only one part, it's one component, one cog in one wheel in the entire mechanism of trying to determine valuation. So you know, I'd call it, they're important because it allows you to understand the more tangible components. You can incorporate tangible assumptions into the model, because what you're essentially trying to do is come up with valuation basis, you know, parameters and whether it's EBITDA or revenue or cash flow, whatever it is, yeah, that can help you, that can give the basis upon which you're now applying the multiple, if you're doing an EBITDA multiple or revenue multiple, to come up with your valuation. But there are other probably more relevant and important assumptions that I would call the intangibles, right? So, you know, the character of the sponsor, the investee that you're going to be investing with, the management team, a number of risks, you know, country, political, environment, especially environmental risks now that need to be taken into consideration. But and always remember that valuation is it's a willing buyer, willing seller position you arrive at between you and as the investor and the investee as well. Okay. So, you know, you can give a very technical and impressive sort of argument, especially if it's the analyst, the modeler who is now trying to defend their position, explaining what's gone into this model. It's a fantastic model. We've made all these assumptions, and this is the valuation that it has, you know, spat out. But you know, and I mentioned a lot of the times these investees are not going to be finance or investment, you know, professionals, or really understand the intricacies of what goes into the model. At the end of the day, you've got to keep it as simple as you possibly can, so that you are arriving at a realistic figure. But it is important. Yeah. But remember, it's only one component of the entire valuation process.
Mm-hmm. Mm-hmm. And I like what you're saying in terms of it being one component, because, you know, as an analyst, because that's at times it's the biggest part of the transaction you focus on, you can get to this point where you think that, you know, it's the only thing that should be considered. And then, you know, you walk into a meeting and maybe you're given only 5 minutes, and the rest of the conversation is really on these other aspects that you're speaking about, the, you know, the management team, the industry, the what etc. And you feel almost, why did I spend the last, I don't know, how many days, sleepless nights, you know, getting the model out, and then nobody's as interested in the document as they ought to be.
Exactly.
Yeah.
You're right.
Okay. And then now just on valuation, you know, there's different methodologies for valuation. There's your DCF, there's your price to earnings, and the multiple approaches that you can use. There's asset basis of valuation and so forth. And there are some methods that you found to be superior, especially in this private equity space than others, or would you use all of them sort of like equally?
Good question. But my position here is that I advise that you should never overcomplicate this process, okay? As I mentioned, this is going to be a willing buyer, willing seller transaction. And what you're trying to come up with is the fairest price, okay? Because you've also got to, you shouldn't be trying to significantly undervalue this asset so you're getting it for the cheapest possible price. Because you remember, you're also, especially if you're going into a private equity transaction where you will be working as co-investors or co-partners for the duration of your holding period, you never want the seller to feel that they have been conned into getting rid of too much of their company for too little money, okay? Mm-hmm. So you're trying to find this middle ground. It's like, you know, buying bananas at the market is a transaction that also incorporates all kinds of assumptions and information in determining the value of that banana. So keep it that simple, right? But I think it's the most objective valuation methodology that applies to the type of company. Is it early stage? Is it late stage? Does it have you know, earnings being generated? Are these earnings consistent Have they been consistent over a period of time, or are they extremely erratic depending on the market and all kind, and the environment they're working with? So, I mean, I tend to use an earnings, EV/EBITDA earnings multiple for companies that have a strong track record of consistent earnings. Okay. I would then look at applying a revenue multiple on companies that show a lot of promise going into the future, but they are yet to be EBITDA positive. But there's 3-4 years of strong, consistent revenue growth. But I would also consider, and then the famous DCF. I mean, sometimes DCF is pure fiction, huh? But what I tend to do is really drive down, look at the worst case scenario in a DCF kind of valuation. What kind of weighted average cost of capital are you applying? What sort of discount factors are you applying? Again, it depends on the environment. Currency risk, now maybe I haven't been in the market since last year, but I don't know whether there's a pandemic risk sort of discount factor that's being applied now. Mm-hmm. And then I also support the use of blended valuations, right? So you can combine your earnings multiple valuation with the DCF valuation and agree on something in between. But remember, you've also got to be a good interpreter and good communicator of the valuation methodology you've used, yeah? Mm-hmm. So that the audience clearly understands why you've used this valuation, why it is a fair valuation that has been used. And then what you're seeing now is many private equity funds I know of are now being very clear about not investing in anything with an earnings track record of less than X or Y over a period of time, or $2 million, on average over the last 3-4 years, because people have been burnt. Yeah, me as the seller, I'm going to insist that you use my DCF valuation because I really think this business is going to go places. It's going to fly. There's the now added complexity of trying to value tech companies that are coming to market with mad, ridiculous valuations of 50 times EV/EBITDA, 100 times EV/EBITDA, from one funding round to the next. But driven by a lot of sentiment, driven by a lot of psych, you've got to have a sober mind that is driving this valuation discussion. But ultimately, it all depends on the circumstances, because I've also seen investors that are literally what I call funding round investors, willing to accept a relatively high multiple on tech, especially early stage tech investments, knowing that they're going to exit to the second or to the next round of investors who are willing to pay even more. Okay. Yeah. But I think at the end of the day, you're trying to arrive at a fair valuation that's really agreeable to both buyer and seller. Yeah.
Good pointers there. Fair valuation, and I like this aspect of being able to interpret the financial model and to communicate the value that you're presenting, because at the end of the day, the model has to be presented to the other party. They have to buy into that. They have to buy into the assumptions that you put through. They have to buy into why the number is what it is. And I think that's one area that, and I don't know whether you agree, that analysts need to spend a bit more time on. Because you can get very buried under your current financial model that you don't realize that at the end of the day, you have to convince someone else of this value for them to actually pay and put some cash to it.
Exactly. No, absolutely. And I honestly think a lot of training needs to be applied. Or let's say, when you're doing your financial modeling training, it's also important to train the analysts on how to communicate, how to ensure that the audience, the users of this information really understand what they're talking about. Because they're not doing it for themselves. So how they speak to it, how they communicate, how they interpret it, use of simple language, where more complicated acronyms or terms that the users are not going to understand are being used. Developing the model is only one part of the equation. Communicating it is another. Yeah.
Thank you. So I want to open this to a few more questions. I have my additional questions here, but probably just to get a few questions here. So I think there's a question that has come in from Kevin. How would you value a startup running a pilot with no revenue?
I think, okay, it's no revenue. It's a pilot. Obviously, the only methodology you have at your disposal is a DCF, and the result, how that pilot has been conducted, what assumptions have been made, is it representative of the market? All these questions have to be asked so that you're also able to apply certain discount factors to that model. But I would also consider using other tools. For instance, where you can base going forward the price you're paying on future events. So if that valuation is achieved, maybe you've held back 30% of the valuation that is being considered. If the valuation is achieved in, or sort of the numbers are achieved in the next 2 years, then you can agree to part with that 30%, or you hold it back so that you end up paying a lower valuation. So there are various tools that can be used to ensure that you're not overpaying for this investment. But they are tricky. You use precedents, I think research on how other firms or investors have valued startups with no revenue, track record of revenues, or else, I think milestone investing. This is where milestone investing becomes important. But do not rely on how much the market has hyped up the business itself or the potential of the business.
That's always a challenging one, this question of hype, because I feel like there's some startups that the hype is so huge that it's deepening to a certain extent, right? And the only problem is that the market only corrects costs in the next funding round or in the subsequent one, which is maybe 18, 36 months away. And so for you as the investor, for you to have your day and to say, guys, what did I say? You have to wait for these 36 months. And I guess there's so many stories of this kind of startups that had a huge hype, and then sort of like later, the market just corrected itself, and now we can see them. So you need to have some strong guts. But anyway, let me jump to this other question by Kezia. Do PE firms use a rule of thumb approach such as X times EBITDA? And if so, what drives these, whatever times multiple? And maybe just to flesh that out a bit, I've met with investors who told me Java, which is, it's one of the brands we resonate with, right? You go to restaurants and so forth. They open a store somewhere, all of a sudden it's flooded. Was done, as I think, from what I hear in the market, 12 times. So I know investors will say, I'm not going to pay anybody anything more than 12 times. I mean, until you can prove to me that you're just as good as Java. So I'm always asking, and I guess that's what Kelly is asking the question here, is what informs the 12 times, the 7 times, the 4 times, and so forth?
Okay. Yes, short answer to that is yes, we do use rule of thumb, what I'd call them industry standard sort of EBITDA multiples that are generated. And I don't know, some of you may have used stuff that's generated by the likes of Equidam and Valentium, and there are a number of other firms. I think Fitch does this as well. We've tended to use ones that are more Africa specific, which are less, what can I say? They're less tested. They are more subjective, less objective. What sort of multiples are being used in South Africa, in North Africa, but then you apply your discount factor as well to correct for your local situation. Yeah, I know. Again, sellers are going to try and, as in the investees, the company you're investing in is obviously going to try and justify the use of in the restaurant business. This is what Java, the Java valuation was able to achieve 12 times EV/EBITDA. But that is not the only similarity between you and Java, is that you're probably in the same industry, but that's where it stops, okay? I talked about the drivers of the business, the ownership, the CEO, the management, how responsive you are to the market, the conditions in the market as well. I know a number of investors, then once the Java story happened, again, hype, they were very keen on entering this market. So Java caters to a certain income group, okay? Java has been able to achieve certain margins, for instance, because they've been in this business for what, 20 plus years? They really understand the market. They understand what's worked. They've made their mistakes. They've corrected these mistakes. I know they they have their own sort of IP, to some extent, that they're not sharing with the rest of the market. So never assume you're comparing oranges with oranges, right? Look at that specific entity, and again, look at those tangibles and intangibles, right? And you then, instead of now as the investor being bought or being convinced by this 12 times, this 12x multiple, you're saying, no, I think 8x or 6x is more reasonable, okay? And you've always got to think of your exit plan if you're a private equity player, especially. What kind of multiple do you think you can achieve if you continue to grow that business over the next so many years? I remember, there was a time, this is common knowledge in the healthcare market. There were certain Avenue, I think it was Avenue Healthcare, that was on the market. There were a number of investors that were keen on pursuing that transaction. You had competitors like Abraj at the time. I think this is just before they had their issues. You had 2 or 3 others that were competing for this asset. So it was sort of like an auction of sorts, yeah. And one of these players, I think Abraj, was willing to pay a multiple of 14 or 15 times. When we had, we were also part of a consortium. We had based our modeling on about 8 or 9 times, all right? So sometimes you just have to walk away. It just does not make sense. Just don't believe the hype, Fine, let them take it for 14, 15 times. You will find something else that's probably less sexy, but it's got more potential. You can get a much more reasonable valuation. So use that multiple, the industry standard, as a guideline. Use your own model, your own research to determine what kind of multiple works for you. But always remember that you can manipulate what you eventually pay for this asset by creating a milestone-based approach, so that you're not locking yourself into one multiple just because you're dealing with a very young business, or the future is unknown. You can also adjust that multiple as the business now begins to produce proper numbers. Yeah. Sorry, Stephen, you're muted.
Thank you. Sorry. Thanks. I was just saying that there's this point that you raised around asking yourself, what exit multiple can you achieve? Because I think maybe that's, for me, that makes it very realistic, right? So if you don't think you can sell it to someone else for 14 times, why would you be buying it at 14 times? Exactly. Unless there's something else that you're seeing, that maybe the company grows really fast. And so even at a lower multiple, you still end up with your return at the end of the day. Now, last question, and maybe on this you can be brief, then we can just finalize. Kevin asked, what discount factors do you consider when doing a valuation? What are the reasons for applying each of these discount factors? This is the last question.
Okay. Okay. Most of these discount factors are based on certain risk parameters. Okay. Now, if I'm investing in a business that is going to generate, when most private equity funds are typically dollar denominated, okay? But this particular investment is going to be primarily Kenya shilling revenue, EBITDA generating. So there will clearly be a currency discount factor that I would apply. I would apply risk factors based on other environmental, factors as well. If I'm going into the agribusiness sector, I'd need to have a very clear understanding of the potential risk of everything that affects agribusiness. Climatic change, what kind of factors does this particular agribusiness depend on? Are these operating under controlled conditions on the greenhouse? Are they, field operations that are important? What's the market looking like? If I'm operating in the coffee or tea sector, even if it's value addition, many value addition agri investors claim that they have managed their risk by not going into the primary business. But still, tea especially, one season the prices are up, the next season they're down. I'm going to look at matters like political risk as well. I mean, that is becoming more and more important. In our part of the world, we have these cycles, and I think at one point in time, we were able to actually model how, every 5-year span, there would typically be, in certain industries, a sudden dip in revenue, and especially in margins and EBITDA, and commodity prices have gone up. So I need to factor that sort of discount factor in. And some of the more unique ones, I think sometimes the sponsor, a lot depends on this person you're investing in. How solid a character is he? Let me put it another way. They may be extremely high performance people that have been central to generating a steady stream of earnings over the years, all right? But in your evaluation, they actually don't have a succession plan, right? Typically, ordinarily, you wouldn't think of factoring that in as a discount factor. But if nothing is done about it before you invest, I think it's very justifiable to do so, right? And we've seen situations where change of leadership does impact the business's performance significantly. But a lot of these, and I'm talking about investing in this part of the world. Some of these factors may not be relevant to investments in the Western Hemisphere, as it were.
Yeah.
But those are the primary ones that I would consider. Yeah.
Okay.
Sorry, wow. And the other one is actually, and this goes back to exit, is liquidity risk. Yeah. How is this a private company that is actually going to be difficult to, I would call it liquidity stroke exit risk. Yeah? Is it going to be difficult to exit this company because we don't have a large number of potential buyers, right? And remember when Stephen, we've talked about this in the sort of exit discussions we've had at SPS. If you haven't engaged potential buyers in this business before you invest, so that you know that the likelihood of exit is going to be 50% or 10% or 90%, you need to factor that into, incorporate that into a discount factor. So the less liquid or the less likelihood of, call it, exitability, or discount factor you'd apply. And the more liquid it is, you probably don't have to apply a discount factor, but that's an important consideration as well.
Okay. Tony, thank you so much for those additional factors that you put in. I think there's a lot to chew on from what you've mentioned. We already passed time, so we have to close in the next minute or so. Do you have any closing remarks before we close the session?
Well, I hope it's been useful, what I've had to share with you. And I implore you to apply, some of the attributes that I had mentioned in the course of our discussion today, being open to criticism, humility, integrity, willing to say you don't know as an analyst, somebody who is now getting into the nitty-gritty of financial modeling, but become proficient at communicating your model as well, and also become, even if it means doing your own research or reading up or talking to people, become more aware of what I was calling the intangible factors. Okay, those aspects outside the financial model that are important when it comes to valuation. Yeah. But I wish you all the success in your future careers.
Thank you very much, Tony. Tony, what we usually do for our sessions is, since we can't do physical claps, is we ask people to go to gallery view, and then it's sort of like clap for the speaker. So guys, if you could go to gallery view and you can use the reactions to say, to put a clap for Tony on the screen, especially if you appreciated the session. So Tony, as you can tell, people are saying Makofi, and thank you so much for that session. We really appreciate. For the rest of the participants, we have the Q&A session this week on Wednesday at 11 o'clock. That will be taken by Kevin. And that's going to be the end of our session today. This is a recorded session. So if you want to come back to this, if you want to pick out the key attributes that Tony spoke about, you can always go back to the video and review them. So asanteni sana, and we'll end the session at this point. Tony, as always, we appreciate your time.